Good morning and welcome to this Monday, November 4th edition of Trading Places Live at earningsbeats.com. I'm Tom Bowley, Chief Market Strategist here at earningsbeats.com, and I'll be your host for the next 30 minutes, featuring everything you need to know as we prepare for a trading day ahead and a new trading week. Opened up a new month, November, on Friday. Historically, this is a great month for U.S. equities. I mentioned last week that we finished off that bearish period in pretty strong fashion. October 21st to the 27th is the worst week of the year. We got through that really unscathed. And then we moved into one of the strongest, if not the strongest period of the year. Certainly when we look at 2 or 3 month chunk periods, these next 2 to 3 months are the best 2 to 3 months of the year, consecutive. So we're in a bullish period. The market was very bullish, breaking out last week to new 52-week highs. Futures are strong again this morning. Looks like new records will be set at the open. And so things are pointing up here as we head into the cooler months. Let's take a look at what's going on. I need to be able to, there we go. Let's go ahead and bring up what happened last week at the end of the week. The Dow Jones, look at the big move there, almost breaking out to new all-time highs. It's going to happen at the open. We'll see if we can sustain it. But the Dow, last time I looked, and I'll give you a quick update on the futures, Dow Jones futures right now up 165 points. So it should be an easy clearing of overhead resistance to all-time highs on the Dow. The S&P 500 hit their all-time highs last week. The NASDAQ also on Friday broke to all-time highs, which is awesome. And we even have the small caps not breaking to all-time highs, but breaking above those summertime highs. So we've really got all of the major indices going in unison, which is awesome. 10-year Treasury yield. This was a little bit ago. Let's get an update here, and I'll go over this chart in just a bit as well. But right now it is up 3.5 basis points. So let's just call it 4 basis points, 1.76%. So pretty good action there. And what we want to see is this continuing to trend higher, money rotating away from treasuries, sending the yield higher. And also that money then can be used in the equity markets to help fuel a continuing move to the upside. I've been very bullish. I've said I believe the S&P 500 will close above 3,200 before the end of the year. And I actually think in 2020, we could see 4,000 on the S&P 500. I believe we are in for quite a run. I'm waiting for transports to confirm that. I'm waiting for the 10-year Treasury yield to confirm that, but they are both certainly cooperating at this point. Energy was the big winner in the sectors on Friday. You can see gaining more than 2%. Industrials also up more than 2%. Look at the breakout on the industrials, new all-time high. Transportation was weak throughout last week, went a little bit below the 20-day, but really stormed back on Friday. That was good to see. Waiting on this breakout above 11,000. I would not be surprised if we saw it today. It could be another big move. If we have another day similar to what we had on Friday, we will be right there at that 11,000 level. I would not be surprised. Utilities were weak on Friday, along with real estate. That's what we would expect in a bull market. They are still fine. They're both trending higher, but they will likely lag in a good, solid bull market advance. So if I was trading ETFs, I would stay more away from the defensive groups right now. I like the aggressive groups because they tend to lead bull market advances. And most everything I look at suggests we're going to go higher. I know there's a lot of still negative news out there. Ignore it. Follow the charts. We're breaking out to all-time highs. Respect what's going on in the market. All right, let's see. Economic reports out today. We do have one report, factory orders, that'll be out at 10 a.m., so a little less than an hour. The consensus estimate is for a drop of 0.5%. Factory orders normally don't have a huge impact on the market unless there's a big miss. So we want to watch. If you see the action start to take a big move in one direction or the other at 10 o'clock, you might check this report and see what happened. But overall, I think the market still looks pretty good here. And I suspect that the 10-year Treasury yield is going to make this break above 185 and eventually above 190. And if it does that, that is a bullish development for the market. One other thing I want to point out with the 10-year Treasury yield, And one of the things that I follow closely, it used to be, when I was taking economics 101 back in school, you just worried about what was going on in the US because we didn't have, all of the global business and, the back and forth and so many imports and exports. And it's just gotten a lot more complex. And so now, instead of just watching what's going on with US rates, we need to be aware of what's going on with US rates versus rates around the globe. And especially the one I like to follow closely is the German 10-year Treasury yield. So I pulled this chart up, and recently, I know one of the last shows on Market Watchers Live that I did with Aaron, we were talking about areas of the market that we thought we'd do well in the fourth quarter. And one of the things I said is I wouldn't be surprised if energy and materials, especially energy, had a pretty good fourth quarter, maybe beating all of the other areas of the market. It's been so oversold, number one. But the other thing I was looking at is I like to follow the difference in the yields between the US and Germany. And when it's going up, when the US yields are rising faster than Germany or falling less than Germany, that's an indication that markets are betting on the US economy being stronger. So you've got to watch this relationship. And with this move to the upside, when you see the 10-year Treasury yield moving higher and faster than the German 10-year Treasury yield, then what you normally would expect is a rising dollar. It's one of the reasons why, I thought maybe that the US, the Federal Reserve, would cut 50 basis points last week instead of 10, just to weaken our dollar to help prop up inflation. And so this was one of the things I was pointing to a few months back, is that we've been dropping now. The US has been dropping relative to Germany in terms of the 10-year Treasury yield, and yet the dollar has continued going higher. This isn't a perfect, it's not like Treasury prices and Treasury yields where you have a perfect inverse correlation. This isn't a perfect positive correlation, but it's been pretty strong. And when you look at the correlation numbers down here between the difference of the two Treasury yields, US versus Germany, and the direction of the dollar, they tend to move in the same direction. That's what these positive correlation readings tell us. Occasionally, though, we do drop into this, negative correlation area. And when we do, you can see that normally we come storming right back. They tend to go right back in hand after these periods. We're just starting to make this turn back to the upside. Now, on the other ones, what was happening is the dollar was declining while, for the most part, the yields were going higher. In other words, the U.S. looked like things were strengthening based on looking at the yields in the U.S. versus Germany, but the dollar wasn't participating. So what was happening is that the dollar would then play catch up. So that's what these highlighted areas were, the first three. The dollar going down while the yield was going higher, resulting, or the net yield was going higher, and that resulted in this negative correlation. And then the dollar would come storming back to the upside. This one's different because the dollar, in this case, has been rising while the yields have been falling. The net yield spread between the U.S. and Germany has been falling, telling us actually that maybe Germany's going to start catching up in terms of economic strength, or maybe the U.S. on a relative basis is just going to falter, depending on how you want to look at it. But what this tells me is that eventually the dollar is going to turn lower, and we've started to see that. So I wouldn't be surprised to see the dollar come back down maybe and test this trend line. If that happens, then we've got to be careful about possibility of leadership, materials, and energy. Why? Because when the dollar's coming down, these are the two groups that tend to lead. They get tailwinds. A weakening dollar helps materials and energy. The problem has been that we've been in this strengthening dollar environment for a long time, and you can see that the XLB, actually this is, all right, something screwy happened here. Ignore some of my comments there. Let's check this with the S&P 500. This is a little bit better chart. Okay, so here's your dollar coming down. Here's your relative strength in materials. Here's your relative strength in the S&P 500. Not all bull markets are created equal. This was a bull market back in 2002 to 2007 that was led by materials and energy, why the dollar was falling. Now we have a rising dollar. So this bull market is not being led by materials and energy. But if the dollar weakens for the next, I don't know, maybe a couple months, few months, maybe into, first half 2016, or excuse me, 2020, if that happens, we could see some leadership coming out of materials and energy. So at least the bleeding has stopped here on materials for a while. We're kind of going along for the ride. But if we see a more measurable drop in the U.S. dollar, I think we could start to see a little bit of outperformance in materials, which would be a good thing. There's nothing wrong with materials and energy leading for a bit. Energy is still struggling on a relative basis. I just wanted to point it out because, again, if that's something that develops over the next few months, we've been avoiding energy and materials for a while, but it's something to consider if we see the dollar really start to move quite a bit lower. All right, we have got earnings. So let's take a look. Just going to go through a few of these. First one is Cisco Corp. This is the food Cisco, not the networking company. SYY. You can see the stock trading up, breaking out on Friday. It's been a pretty good relative performer over the last couple of months. It's been strengthening after not performing so well relative to its peers. Starting to strengthen. I do have numbers here. Let's see. Cisco beat on their bottom line, 98 cents versus 97. And I'm going to give you the latest price in pre-market right now. Right now it's flat. Last trade I'm seeing, which was 5 minutes ago, down 7 cents to 81.21. So, which isn't bad. I mean, we remain in the uptrend. I would watch that 20-day moving average as possible support on any pullback. And what I want to really see is this relative breakout to about a 5-month or 4-month relative high on Cisco. So if we can continue to outperform its peers, I think the stock looks pretty good. One problem though is it's in the defensive area of the market, and that normally is going to make it a struggle to outperform the S&P in a solid bull market advance. Okay, next up on the earnings, let's take a look at Ferrari. No pun intended, but it is racing ahead. Nice move here the last month or so, coming off that bottom. On a relative basis, this was a leader versus the autos a couple months ago, but it's since pulled back. It had a pretty strong drop and then mostly just went sideways. But the numbers here were strong. $1 versus 93 cents. They beat on their revenues. They upped their fiscal year guidance, and the stock was up pretty nicely in pre-market action. I know it was up about 6% earlier. I'll give you the most recent here. It is up 6.5%, $10.57 to $171.95. It is breaking out above this earlier July high. Very, very bullish. If we open up above 170, I think that is a bullish development here on race. If it opens up, say 169, 168, it can't quite make this breakout, then maybe we come back down, fill the gap. But I do think race looks good and a very solid earnings report. This is one we're certainly going to want to keep an eye on over the next quarter. Next earnings report up. How about Sprint? If race was racing, I'm not sure Sprint's been sprinting unless it's backwards. You can see the chart's been going down the last 3 months. The group been moving higher, wireless telecom. However, you can see that Sprint has been on a relative basis very, very weak. They missed by a mile on their earnings, came in with a loss of 7 cents, only expected to lose 1 cent. So not very good there. They missed on their revenues. They lost 400,000 subscribers. When I first saw the news, I'm like, wow, okay, we're going to see a pretty big drop in Sprint. And this just goes to show you how crazy the market is sometimes. Actually, it is down. I was going to tell you it was up because it was up earlier. It was actually up a nickel. It is down 18 cents right now to 6.12. So that's down almost 3% today. And that takes us right down in here around 6.12. I would suspect we're going to go back and test these lows just below $6. And then we'll see from there. I would be worried if this deal with T-Mobile doesn't go through. I don't think Sprint on its own is based on the fundamentals, looking at the chart. If this deal were to fall through, I think we got problems. All right. What's next here? How about, oh my gosh, we got to talk about Under Armour. Okay, Under Armour, looking at the chart, big gap down back in July. Couldn't really get anything going here. Look at the relative weakness, just absolutely fell out of bed. 2 weeks ago, hit a 52-week relative low. There's usually a reason why, and the reason why came out this morning. Under Armour beat on the bottom line, 23 cents versus 18. Congratulations there. Unfortunately, revenues were just in line, and they guided revenues lower, and now there's an accounting probe. And being a CPA, that is one of the least favorite things I ever want to see when I own a company. That to me says sell with a capital S and about 10 exclamation points after it. I don't trust anything when we start talking about an accounting probe, because it just means all the numbers that the company's currently valued on, you don't know whether they're good or not. I mean, you literally are rolling the dice if you decide to hold a company like this. Under Armour down 15.5% right now. Actually, 15 and three quarters, keeps dropping. 1780 is where it's looking to open today. That is going to be way down here. Oh, just another cockroach in the kitchen when the stock's downtrending. That's what I always say is one of my favorite Wall Street adages. There's never just one cockroach in the kitchen. When you start seeing these big, heavy volume moves to the downside, a lot of times you'll see another one and another one. Do not trust Under Armour right now. It's a shame because I do actually like their athletic gear, but I follow the charts, not the fit of their athletic gear. And right now the charts are saying, get the heck out and stay away. Let's see, one more, NSP. This is Insperity. Look at the chart. See this big drop here? And then a little sideways action. Here's a nice little cockroach in the kitchen. You ready for the second one? How about these earnings? Expecting a $1.01, came in at 75 cents. Not good when you're missing by that kind of a margin. As far as their reaction, how about minus 27% this morning, down to 78.80. If this relative strength stuff doesn't somehow resonate with you, I don't know I don't know how to explain it any better. When you have a company that is a major underperformer, takes a huge hit like this, and don't get too confused by the fact that it's been coming back. Stock was incredibly oversold. It went from 145 to 90. You get some bottom fishers, you get some looking at value, blah, blah, blah. So you're going to see a little bit of a move back to the upside. I think it's pretty clear the stock is way, way far away from its 52-week relative high. Very difficult to look at this chart and like it. Heavy volume selling for 2 or 3 weeks, and now we get the lighter volume push back to the upside. Never know when the next shoe is going to drop, but for NSP, that is today. All right, that's it for earnings. Let's take a look at a couple of upgrades and downgrades today. This is the first one's pretty interesting chart. CFX, it is in the industrial machinery space. I've been talking about industrial machinery. Check out the breakout it made on Friday, and look at the volume over the last week and a half coming into CFX as it makes a break to the upside. Look at the relative strength. You have a leader in industrial machinery. So if industrial machinery truly is moving, then CFX is one of the stocks you certainly want to keep on your radar screen. Now, it has been overbought here for a while now. It's straight up. It's quite a bit away from its 20-day moving average. You do have some really good price support, gap support in here just below $33. I'd have to see a little bit of a pullback, but this one I definitely would keep on my radar for sure. All right, how about Marvell? All right, Marvell. And by the way, so the upgrade that we got with CFX, I would completely agree with that upgrade. I think that that is noteworthy. And don't know why I'm not getting this chart to come up. There we go. Marvell Technology Group moving up, sideways consolidating. Semiconductors have been going up. This isn't one of the best stocks in the group, but it had been okay for a while. I think, you know, with the moves here to the upside recently, the volume hasn't been great. It's being upgraded. Personally, I think I like some of the other semiconductors a lot better. It's not a horrible chart. Maybe to the downside, just watch this 2275, 23 area for support. But I think if you're looking for a leader in semis, this would not be one I would turn to. Let's see, downtrends or downgrades, I should say. Fleur, big gap down after earnings, came back up. I don't really trust these when you get the huge gap down. I mean, we're talking about a $9 gap down on Fleur Systems before. We got a nice recovery. Now we're getting a downgrade. I want to check and see what this one is doing. Pre-market, FLIR. And I'm not showing anything other than a bid that's about $1 below Friday's close. So not really showing me anything. I would expect this is going to roll back over to the downside, though. Not a fan. I also don't short in a bull market. When I believe we're in a secular bull market, I'm looking for opportunities to put money to work to go higher. I'm not trying to find the small number of stocks that are going to go lower. So I think trying to short is a futile exercise in a secular bull market advance. All right, well, let's keep moving on. Let me see if there was any other downgrades. Actually, let's take a look at one other downgrade, which was HOG, H-O-G, Harley Davidson. I actually like the stock with the gap up. Notice the relative strength just hit a 52-week high. Yes, we pulled back the last week and a half, but we're just sideways consolidating. Stock had a nice gap up on earnings, heavy volume. I like the stock, and I'd really like it on a breakout above about $42. To the downside, though, after earnings came out, you saw buyers come in just above 38. You got the 20-day moving average coming in at 37.91. So I could certainly argue for a buy on this stock. So I do not agree with this downgrade. Sometimes I use downgrade simply as an opportunity to buy a stock that I like at a cheaper price. To me, one analyst doesn't know a whole lot more than all the other analysts, or to be honest, doesn't know a whole lot more than what we know from looking at the charts. So I would use the opportunity. If you're a fan of Harley Davidson, I would use the opportunity anything lower to maybe get in closer to that 20-day moving average. As far as pre-market action, the stock is down 69 cents to 38.64. So it is getting down closer to a key support, short-term support area. Maybe able to take advantage of that. All right, let's move on. Monday setups. Hadn't done those for a while, but I did them last week, so I'm going to stick with it, do it again this week. I did not plan this, but every one of the Monday setups starts with a C. I was looking at the charts, and after I put the fourth one down, I was like, all right, that's kind of crazy. But I'm going to go ahead and pull these up for you one at a time. First one is Cons Inc. CONN. The stock moved up very nicely on earnings back in September. Went from a little over $20 a share up to almost 27.5 in 2 weeks. Needed a consolidation. I think it's gotten it after this move to the upside, which was higher than this high over here, which I think is important. I believe we're going to hold on to this 23 level. And as it's been sideways consolidating, you can see when we do get these pushes to the upside, we get a little bit of pop in the volume. I think there's accumulation taking place. I think we're going to make another run for 27 and eventually break out. So I think the weakness that we saw last week in cons is an opportunity. Specialty retail hasn't been great, but it does look like it's starting to turn higher. It's at a 3-month high. And coming off of these lows, you can see cons has been one of the relative strength winners. Now, it doesn't look so great the last month, but remember, we're consolidating. Had a big move up. We're sideways consolidating. When you do that and the market's going higher, you're going to show weakness on a relative basis. I don't think that this is a bad thing right here. We'll see. To the downside, watch, like I said, I'm going to take 22.5, 22.75. I wouldn't want to close below that level, but I believe CONN cons heads higher. CLDR. This is Cloudera. Little bit more aggressive, but I like this push to the upside. This now, heaviest volume in the last year, this now looks like an exhaustion gap to me, which means the selling has ended. I think when we gapped up back here in August, we began an uptrend, broke out above the 20 and the 50. The 20 crossed the 50, and now we're trending higher. Gap up, heavy volume push to 9.5, came all the way back down, tested the top of this gap support, sideways consolidation, hit the 50-day moving average last Thursday. I think this one could be poised for a run to the upside. So I like CLDR. CTAS, Cintas. Really like this stock. This is in one of our portfolios. Stock made the breakout recently after reporting earnings. Came back down right on the 20-day moving average. Like I said, just broke out even though its group's been downtrending. What does that mean? You got a 52-week relative high just last week before we pulled back a little bit. So CTAS, I think, is good. And the last one for Monday setups is Costco. Always love me some Costco. Actually, I'm not a big shopper, but I enjoy going to Costco for some reason. No idea why. But here it is. Nice uptrend in play. Huge, huge move back here. Earnings related. And then look at this cup. Nice little cup, pulls back in a handle. I think this is one that could go. A breakout above about 305 on increasing volume would measure up to 330. So Costco looks pretty good. All right, those are the Monday setup. So I am going to wrap up the show with 3 you must see. These are 3 charts I just think that are worth sharing. I'm going to start off with, and I'm going to do industries today. So we've been doing a lot of individual stocks. That's mostly what I have featured during these 3 you must see, but I've got 3 industry groups I want to feature today. And I'll give a shout out to my daughter, Erin, who many of you have worked with. She updates me every week on how these industry groups are changing. And so I use a lot of that to kind of come up with things that I want to share. And so first up, let's pull up semiconductors. I mean, this is a group, and talking about, we got a webinar coming up today at 4:30. If you're not already an Earnings Beats Digest member, which is a free subscription, if you're not already a free subscriber there, go sign up. We're going to be sending out room instructions for a 4:30 webinar tonight where I'm going to be taking a look at earnings, upcoming earnings reports. We've been doing this a lot lately. We've had a lot of success, even though there's been some misses in there as well. You hold into an earnings report and you're literally flipping a coin. I think we maybe with relative strength have a little bit better than the 50-50 shot, maybe 60-40. But that, I think that turns the odds in our favor a little bit. We're going to talk about that some during the webinar tonight. And I'll give you some stocks to watch. But the reason I mentioned that is semiconductor. Some of the earnings reports coming out in this group have been just phenomenal. I mean, I can point out Lam Research right off the bat. IPHI came out last week, absolutely exploded on earnings. And there are plenty of others. KLA had a great report, but the stock had gone up so much, actually pulled back, and was one of the reasons why we saw a little weakness last week in the semis. But we came storming back on Friday. I think this group is going higher. And so it's one that I wanted to feature in the you must see. Chart breaks out above this 3,900. I'm going to just pull up a longer term weekly chart. And you can see this is a big deal. We are breaking out above all of these highs from 2018, 2019. This is an aggressive group that tends to really push to the upside with earnings, with strong earnings. I mean, because these companies tend to grow earnings very, very rapidly, and the market anticipates that. And that's why we're seeing such a huge move here and getting this breakout. All right, next up is the DJUS FH. So let's go ahead and start with this weekly, and then we'll zero in. Had been in a downtrend throughout 2018, a couple reaction highs here. We have easily cleared that, though. This is a group that has really turned to the upside, very strong. If I go back and we pull up the daily chart, you're going to see, I mean, look at this move. Now, probably not a great idea to chase, but look at the volume. There's a lot of accumulation taking place in this area of the market. So if you do get a pullback, I'd be looking for some of the companies within this space. The way you can find them, Furnishings Index, all you have to do is go back to your member tools on the dashboard and go down to Scooter Reports. It's under summary pages. Hit Scooter Reports. It shows all the large cap stocks in Scooter order. And if I type in furnishings, boom, there are a couple of them. Leggett and Platt is on fire right now. This is they had a great earnings report in a bull flag right now. Watch this one. If it pulls back down into the upper 40s, I think this is going to be one certainly to consider. But that's just to show you pretty quickly how you can look for these. And then you can change this to mid cap, Tempur-Pedic scooters in 98, small cap. And you can see a bunch of these. I like Sleep Number, talked about that. That was one of the earnings I really liked going in. The company came out with great numbers. I think Tile is one that's improving. Yeah, I got a breakout. Look at the earnings there. So there are a lot of quick ways to go from relative strength on the industry charts to individual stocks. All right, last one I want to show you, and this is the biotech group. Biotechs all of a sudden are catching fire, and we've talked about this. When they move very, very rapidly. Amgen just broke out last week with earnings. I'm going to pull up last thing, a longer-term weekly chart. We are now up above both the 20 and the 50. We had not been there for the last 6-7 months. So this is a big deal. If we break 2050, you connect these highs, it's just below 2050. Here's a really big reaction high, 2050. Got to break through there. All right. Want to thank everybody for joining us today. Keep checking out Trading Places Live. Check out my blog over at Stock Charts Trading Places with Tom Bowley. And remember, we got a webinar coming up today at 4:30. Everybody have a great day. Happy trading.